In 1981, the US Fed hiked rates to a brutal 20%. One month you're buying homes, the next no one can afford milk. That's how fast the party ends. But what I'm about to show you at the end is even scarier. Number 1. The party is in full swing. Imagine the best party you've ever seen. Music loud, lights flashing, people spending freely. Everyone feels rich. Everyone thinks the fun will last forever. That's what the economy feels like in a boom. Stocks are going up every day. Banks are happy to lend money. People borrow to buy houses, cars, and even more stocks. We've seen this many times in history. In the 1920s, called the Roaring Twenties, the US stock market more than doubled between 1925 and 1929. People could buy stocks with borrowed money, sometimes paying only 10% up front. But in August 1929, the US Federal Reserve made it harder to borrow. By October, the market crashed, wiping out billions of dollars and starting the Great Depression. In the 1990s, the dot-com party started. Investors poured money into internet companies. Many had no profits, some had no real products. The Nasdaq stock index tripled between 1997 and 2000. But when the Fed raised interest rates 6 times in 1999 and 2000, the bubble burst. By 2002, $5 trillion in value had disappeared. More recently, after COVID in 2021, money was everywhere. Governments sent out stimulus checks, interest rates were near zero, and people had savings from lockdowns. Tech stocks and even cryptocurrencies exploded. But inflation hit 9.1% in 2022, the highest in 40 years, and the Fed started raising rates fast. The good mood ended almost overnight. When times are good, it's like a DJ playing hit after hit. Everyone's excited, more people join in, and the energy builds. The higher prices go, the more people want to buy, and the cycle keeps going. But no party lasts forever. Somewhere in the corner, there's always someone looking at their watch, ready to turn on the lights. And in the economy, that person is the central bank. The Buzzkill arrives. The party's at its peak. The DJ's ready to drop another crowd favorite. And suddenly the lights flick on. A serious-looking person grabs the microphone and says, "Everybody, we need to talk about inflation." That's the central bank. In America, it's the Federal Reserve. Their job is to stop the economy from overheating. When there's too much money and too much spending, prices can rise out of control. That's called inflation. Inflation sounds small, but it can destroy savings and crush families. In the US, the Fed tries to keep inflation around 2% a year, but in bad times, it can explode. In 1979, US inflation hit 13.3%. Prices were almost doubling every 5 years. The man who became the ultimate buzzkill was Paul Volcker, the Fed chair from 1979 to 1987. He raised interest rates to a record 20% in 1981. This killed inflation, but also caused a deep recession. Unemployment hit 10.8% in 1982, the worst since the Great Depression. Even in recent years, one speech from the Fed can change the mood instantly. On November 30th, Fed Chair Jerome Powell said inflation wasn't transitory anymore. That one sentence made the stock market drop. Investors knew interest rates were going up, and the free money party was over. When this buzzkill shows up, big players look for the exit as money gets expensive. It's like music turning from dance beats to slow jazz. The crowd thins out. But here's the tricky part. The Fed doesn't want to ruin the fun completely. They just want to stop people from getting drunk on cheap money. The question is, how do they decide the right moment to step in? Because stepping in too early can kill growth, and stepping in too late can make inflation impossible to control. Turning the music down. Interest rates as volume control. Imagine the DJ at our party slowly twisting the volume knob. The music drops a little, the bass isn't thumping as hard, and suddenly the room feels different. That's exactly how interest rates work in the economy. They're the volume control for spending, borrowing, and investing. When interest rates are low, it's like the music blasting at full volume. Borrowing money is cheap. People rush to buy homes, cars, and start businesses because the monthly payments feel small. Credit cards don't hurt as much. Companies expand, hire more workers, and stock markets dance higher and higher. But when the Fed turns the knob the other way, raising rates, it's like turning the music down. Loans get more expensive. Your mortgage bill jumps. Credit card interest eats into your paycheck. Businesses hold back on hiring or cancel big projects. The dance floor starts to clear. You can see this in history. In 2003, after the dot-com crash, the Fed kept rates at just 1%. That made money so cheap that houses were flying off the market. Prices in some cities shot up by 10% a year. Everyone thought the party would last forever, until the music stopped and the 2008 crash hit. Fast forward to 2022. At the start of March, interest rates were near zero, only 0.25%. By March 2023, they had soared to 4.75%. That was the fastest jump in 40 years. Mortgage rates doubled from about 3% to over 6%, and suddenly people couldn't afford the same houses. Stock markets tumbled, wiping out $9 trillion in value in just 1 year. And it's not only America that feels it. When US rates rise, the dollar gets stronger. That's bad news for countries like Argentina or Turkey that owe money in dollars because suddenly their debt costs explode. Just a tiny rate hike, even 0.25%, can move billions of dollars around the world. But here's the dangerous part. As Manuel Ayau warned, sometimes even a small twist of that knob can throw the whole party off balance. Ayau's law, the fragile dance floor. The dance floor is packed. People are shoulder to shoulder, moving together like one giant wave. But if one person trips, the shock can ripple through the crowd, sending dozens tumbling. That's how markets work when they're built on spontaneous order. A natural balance that forms when millions of people make their own decisions freely. Manuel Ayau, the Guatemalan economist, loved to warn about this. He compared markets to a delicate dance floor. A single wrong move from above, like a sudden interest rate change, can throw the rhythm completely off. Once trust breaks, it's almost impossible to get everyone dancing again. History proves his point. After the 2001 dot-com crash and the 9/11 attacks, the Federal Reserve kept interest rates extremely low, just 1%, for years. It seemed harmless at first. Cheap loans fueled a housing boom. From 2002 to 2006, U.S. home prices jumped by more than 50%. Construction cranes filled skylines, and banks handed out mortgages to anyone with a pulse. But the floor wasn't solid. It was fragile. When rates started rising in 2006, the housing market cracked. By 2008, it collapsed entirely, triggering a global financial crisis that erased $19 trillion in wealth. Japan's story is even stranger. After their asset bubble burst in 1991, Japan's central bank kept interest rates near zero for decades. They even tried negative rates in 2016, meaning you'd pay the bank to hold your money. But it didn't work. People were too scared to borrow. Japan's GDP barely grew, only about 1% per year, while its government debt ballooned to over 200% of GDP, the highest in the developed world. Ayau's warning was clear. Markets rely on trust, rhythm, and freedom. If you try to fix them with too much top-down control, you might break the very thing that makes them work. And once the dance floor collapses, you can't just turn the music back on and expect everyone to keep moving. Number 5. When the party clears out, the music is still playing, drinks are half finished, but somehow the dance floor is empty. People didn't leave because they wanted to. They left because they were scared. This is what a market panic feels like. Sometimes it starts with just a few people heading for the exit, selling their stocks, pulling money from banks, delaying investments. Others see it, panic too, and follow. Suddenly, what started as a small shuffle becomes a stampede. In June 2022, the U.S. stock market officially entered a bear market, meaning the S&P 500 had fallen more than 20% from its recent peak. Why? The Federal Reserve had raised interest rates faster than at any time in 40 years, from 0.25% in March 2022 to 4.75% by March 2023. Higher rates made mortgages, car loans, and business borrowing much more expensive. Investors feared a recession, so they sold. wiping out trillions in market value in months. This isn't new. On October 19, 1987, Wall Street saw Black Monday, the single worst one-day drop in U.S. stock market history. The Dow Jones fell 22.6% in just hours. While the crash had multiple causes, many traders blamed worries over rising interest rates and inflation. Market panics are dangerous because they feed on themselves. Prices fall, so people sell to avoid bigger losses. That selling makes prices fall faster. Liquidity, the ability to buy or sell quickly, dries up. Suddenly, even healthy companies can't raise money and banks pull back lending. And here's the twist. Sometimes panic isn't even about what the Fed does. It's about what people think the Fed will do next. If traders expect more rate hikes, they might sell before they happen. That means the market can collapse on nothing more than a speech or even a hint in a central banker's tone of voice. When fear takes over, the party ends quickly. The hardest part isn't stopping the panic. It's figuring out how to restart the music without everyone rushing for the door again. Can the Buzzkill save the party? The lights are back on. The music is quieter. People are still in the room, but they're not sure if they want to start dancing again. That's what happens after the Fed steps in. The big question becomes, can they bring back the fun without making the room overheat again? Economists call this a soft landing, slowing inflation without tipping the economy into a recession. It's tricky. In 1994 to 1995, Federal Reserve Chair Alan Greenspan pulled it off. The Fed raised interest rates from 3% to 6% in just a year to prevent inflation. Growth slowed, but the economy didn't crash. Stocks actually rallied afterward, and the U.S. enjoyed one of the longest economic booms in history. But history is filled with more crashes than soft landings. In 1929, the Fed tightened credit to stop stock speculation. Borrowing costs soared. The party ended in the Great Depression. Unemployment hit 25% and GDP fell nearly 30%. Some economists, like Guatemala's Manuel Ayau, warned that maybe the Fed shouldn't try to control the music at all. He argued that markets, like parties, have a natural rhythm, and even small, well-meant interventions can throw everything off. But there's a twist. In some countries with no strong central buzzkill at all, the party hasn't just overheated, it's burned down completely. And those stories might make you wonder if a little interruption is better than no control at all. You've just seen how one decision can crash the world's biggest parties. But there's more they don't want you to know. Tap the next video on your screen and join the few who see the full picture.